Hello, folks. Welcome to the State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Today is Monday, July 28th, 2025. Hope everyone is having a great day. As usual, if you want to go to tradestation.com and go to our homepage and you go around and you look and you'll see a blog post with a sailboat on it. And that is the blog post that has some information with some items we're going to be covering today. I'm also going to share some links with you in the chat. Good. All right. Let's bring up our standardized returns of some ETFs we're going to be talking about here. All right. I also want to remind you that TradeStation is preparing to launch Titan X, the next generation of our trading platform. It isn't just a new model of our award-winning software, but a fresh trading paradigm that puts you in the cockpit like never before. Titan X will be available to customers as a beta soon. If you're new to TradeStation, you can join the waitlist at tradestation.com/Titan-X. Okay, so if you're on TradeStation here, you can go to you go down the page, there's a blog post here. And this blog post has some of the things we're going to be covering in this webinar. So, it's an interesting I got some beeps going off on my other screen. Let me silence that computer. So basically we have just this kind of continuous drift. And of course, we have to remember, is our article today, we have to remember that we have these major events coming up on Wednesday. In particular, Wednesday is a very big day. We have GDP in the morning, and then after that, we are going to have the Fed at 2. And then we have 2 big earnings reports immediately after that. If you look down the page here, you can actually see, we talked about this last week in our webinar. Down here, we talk about this. So I think, to me, the thing that here does kind of stand out is essentially that the market is, climbing a classic wall of worry. And what we really see here is essentially when you have a thrust of this nature, it's hard for it to turn bearish quickly. So there's some things you might be worried about, the market might be worried about, or you can say the market should be worried about. But I think we also have to remember that the technical setup with this kind of recent breakout above these highs does not lend itself to a quick onset of fear. If anything, it lends itself to a degree of now what could maybe be called complacency, which will resolve in things getting better and it all makes sense, or it resolves in the direction of, wow, that was a mistake, and it goes the other way. So right now, I think the key thing is that people know what's coming, and it's earnings and these other events. And so my thought is off the bat is that if any big risk is to emerge, we have to look at the calendar and realize that it could very well take shape later into earnings season. So the real heart of earnings season starts this week. It is the busiest week of earnings season with over 160 members of the S&P 500 reporting, and that puts us in a place where people can kind of if you are going to be bearish, you wait for the other side of those events. If you are going to be bearish, you wait for after the Fed. And I would almost just kind of point out into the future here that if there is anything to be more worried about, August 22nd is probably when Jerome Powell will speak at Jackson Hole. And then we get into that period of time about September, when the seasonality tends to be less favorable. So I'm not trying to be bearish here. I'm just trying to kind of lay out that essentially what, the state of the market right now could very well be a relatively calm drift for the time being. With these events coming, which kind of create more of a positive bias overall in the market. So here's our article, but the key thing today is that basically we got these. Well, first, let me just say that last week we were talking about the housing stocks a week ago, and those have been one of the best performers since we last did our webinar. So, we kind of look at these things that sometimes have a lot of bad news priced in. The HGX home builder sector on the weekly chart had this big rally the day after we did our last webinar. So I want to just kind of mention that. And also, if you look back at the our market trends back on Thursday, there were 2 stocks that we actually had in our rundown. One of them was Wayfair, that we didn't talk about it. I just didn't get to it, but we had noticed that it had this kind of short squeeze potential. And the other one, we had noticed that there was potentially an oversold condition in Texas Instruments. So those things have both kind of played out. If you want to look back at that, I didn't have time to get to that, but don't forget we do these webinars on Monday and Thursday. Thursday we look more at individual stocks. Mondays you look at the overall indexes and sectors. So I think right now we have, we got this last night, the European news, and we basically got the announcement of this, trade deal, whatever, with Europe. And I thought this is kind of interesting that if you actually look at the article, there's an article in Reuters, Energy, which I have found to be a pretty credible, place for energy news, is that they really downplayed this whole thing with the Europe buying natural gas. It's interesting to look at a stock like Cheniere Energy, which is a classic natural gas export, LNG name, and it really, they solely sold the rally and it's really stuck here. So it is kind of interesting that a lot of this stuff seems more performative than substantive. And I think in some ways that's actually a positive because it kind of shows that there is a political will in many ways to make these things go away, which is, actually somewhat positive because it kind of means that, we don't, there doesn't have to be significant success. And this is more of something when it's just like, it's an irritant that can be removed from sentiment. And I think that is an important thing to realize is as these things play out. Right now, we have new round of talks with China. I think in Stockholm with Scott Bessent, and one of the high-ranking Chinese guys. And, apparently it's going to be kind of this week. But again, it's one of these things when they can just agree to extensions, push it down, push it out. And I think that's kind of interesting. There's another article I saw. It was a note from Piper, and it basically said that they think that most of the tariffs are going to get thrown out by the Supreme Court. Now, I'm not a lawyer or anything, don't know, but it is interesting. I've actually been thinking for a long time that there is a significant legal problem with a lot of these tariffs, just because of the fact that they are so unusual without solid precedents. I mean, to back them up, tariffs this magnitude done at the executive level have not historically, I think, really ever been done in American history. So I think, there's always a risk of something that's truly unprecedented, especially when it's economic and you have powerful corporate lawyers with a lot of ability arguing it. Those sort of things are, I think, interesting to think about. And now Piper is coming out and basically saying that they think there's a risk that the entire tariff, all these tariffs we've seen, this year, and a lot of the trade deals that include the tariffs, they could all get thrown out by the district court and then the Supreme Court. So I want to just mention that because, as you kind of look out, the events on the future, they might sound maybe, this or that, but maybe scary, maybe not, but there are reasons to maybe look at it and actually see that things continue to break in a positive direction. So I think it's important just to realize that a credible bank is making that call now. And, it's interesting when a prediction like that is made at the legal level. Now, then we have the S&P. Now let's look at another one. Got to mention, gold is, staggering again here. And I think this is just kind of telling us gold has not made a new high in many weeks. Let's measure this. I'm using TradingView for this. TradingView is always useful for some of these things you can jump around quickly. All right, so 15 weeks without a new high here in gold. Now the S&P making a new high last week, maybe even this week, we made a new high slightly in the open. So I think it's important to realize here is that basically, gold, the risk, the kind of safe haven or whatever you want to call it, is really struggling as S&P moves higher. And we're going to get to it, but I mean, the dollar is showing positive signs of a reversal to the upside that we've gotten into. So the one thing I do want to mention that is out there, I think, is the fact that there is this talk about putting these aggressive sanctions on Russia. Trump allegedly said he's moving up the deadline on Putin from 50 days to 2 weeks or something like that. Risk 100% sanctions. In the Senate, they're talking about 500% sanctions or tariffs. So those things are kind of lingering out there. For the most part, I'm sure the market does not really believe that those sort of things are going to happen, but those are, kind of floating out there as risks as we move through the summer. And so I think that's just something to kind of bear in mind. And so, I mean, it has, I think, a little bit of a potential to kind of pop up. For the most part, I think that the market just doesn't want to believe that really any of these tariffs are going to play out in the worst case scenario. The other thing that's interesting, if we look overall, I don't have it on my trade station loaded right now, but we just keep seeing rotating strength between the sectors. So last week, for example, we had industrials financials breaking out to new highs. So this is kind of just the risk on sectors continue to kind of outperform, but we also see rotating strength. Like last week, healthcare was the leading sector. That's not necessarily bullish overall, but what matters is that there's rotational strength when it's not focused in one place, which is another way of saying breadth is very positive. People are finding lots of places to be kind of bullish, and that is a sign of money just coming into the market and remaining, positive. Also, if you look at this article, we're not going to get into it now, but in this article, we do kind of have a little discussion about some AI names that were kind of interesting down here. You might want to take a look at. Um, Overall, it's just interesting. I also thought was that the Treasury Department reported strong demand for 20-year bond auction last week. Jobless claims, healthy. So we have a situation here where I think that the big kind of surprise, and I've been saying, is that we could have a return to normal when basically it's like just this surprise of nothingness when the bad stuff doesn't actually happen. So I want to just kind of point that out because if we have a situation where there's demand for treasuries and the Fed doesn't have to cut and the dollar strengthens and people sell gold and they get away from global stocks and AI stocks are doing well and the big tech stocks are reporting earnings, that can turn into potentially something that keeps supporting the large cap growth stocks. Now, another thing I did want to mention just is that basically in the communication sector, there are these like Charter Communications. I got to say, I was looking at things like Charter, Verizon, Comcast, AT&T, and their businesses are not like magnificently, amazingly wonderful. They are in a situation where they've been losing the overall cable, business, which is more profitable. They've been turning into a commoditized business, and these guys also have lots and lots of debt. So Charter got really hammered last week. We did a trading view idea on Verizon recently, and we said it was kind of, looking at a spot where it had some potential trouble. So I think it's important to realize that these guys are in the XLC. So XLC has been bullish. It has Meta, it has Google in there, it has Netflix, but there are some other names in there that are, they're very, it's a weird sector to put those together. But I think it's just important to realize that some of these names, Verizon, AT&T, Comcast, and Charter, these are the big ones. They all have a lot of debt. And honestly, if you look at T-Mobile, they had a good quarter and people really have been selling it. These are all in the XLC. So I think we got to realize here that amid the things happening in AI, there's an emerging weakness in telecom. And so I think we got to just realize that. So I want to just mention that it's a kind of a quiet sort of issue bubbling up on the XLC that we're going to get to. I did want to mention that. Now I'll just say off the bat, I look at anything right now. I think right now we might be in a spot when we are potentially starting to think about a breakout in the Dow, the DJI. We're going to get to that, inching toward a potential breakout. And if anything looks like maybe it has a more kind of potential to the downside, it could be, breakdown in things like this is the gold miners with the XAU USD here. That to me, I think still does kind of stand out is, we get it, say we get a trade deal with China, and other things with the Fed and everything else. It just, I think we just got to realize here's a gold's been parked up here doing nothing. I think it really surprised people, and a lot of people started talking about de-dollarization, central bank buying, and it's kind of like J.P. Morgan with the shoeshine boy. When everyone talks about it, you got to wonder. And I just think that this move in gold has been so kind of huge. I think there's there could be some people trapped in this. So I don't want to be overall saying anything like overly bearish about gold, but I think we have to realize is that this is basically an asset. It's a piece of metal that doesn't earn any money. It doesn't do any innovation. It doesn't do anything. It just sits there. And people might say, why am I holding this thing that's up so much, $1,000 in the last, since the beginning of the year when AI is doing well and the Fed's not going to cut and geopolitical risk is falling and tariffs have peaked and blah, blah, blah. It could be a hard thing for gold here. So I think we have to realize we're in a second half and gold's been lagging here. It was really a first quarter move. So these are the overall quick little things I wanted to say. Now, as we dig into the S&P 500 SPX on TradingView here, to me, we have essentially a level around the close of 2 weeks ago. So in my view here at the Fed meeting and everything else, there can be some volatility and kind of small chopping, but there's really not very much. Flip to the daily really quick on the S&P here. In my view, this is something where people might look for, kind of a move down into this level. So a kind of move down towards 6,300. There's space throughout here to kind of fill and stuff. But at this point in time, there's really nothing to suggest much more downside. So, I mean, just looking at it technically, people might look for moves down, around 63.20 area, kind of down in here. That to me is something that, maybe people would look for after the Fed. You can just get a reaction to the Fed with volatility picking up. That is very common, and that's something that people might be looking for. That is the S&P. The Qs, QQQ, very similar sort of environment here. Let's go back to the weekly. Basically with the Qs. Now remember, in this webinar, we look at the big indexes mostly on the weekly charts. And again, we do have this level. It was the close of the week that began July 14th, basically 2 weeks ago. You look at that level, and then you have basically where it opened the following week, and the low kind of down around 50, 559. So from my view here, again, this has the potential to kind of chop and fill down into these candles. People might look for the high back here on July, the kind of close around July 21st, which is a closing price around kind of 564, 565 on the Qs. Again, with all the earnings and everything coming, it's going to be dependent on that. The charts don't matter so much. The charts tell you is if we get some bad news from some of these companies like Microsoft, then maybe that's where we get support. And if it's good news and they decide to extend higher, then these levels won't really have a whole lot of relevance at this point in time. I think things like the S&P and the Qs themselves don't have significant opportunity as indexes. Now the Dow, however, this looks like this might be setting up now, trying to have a breakout. I think we just need to kind of wait and watch and see. But from my view here, I think people might be looking for a confirmed close above the high back here from November. There's a closure around 44,900. And it's more or less where we're sitting now. So from my view here, the trade that could be interesting could be a potential breakout in the Dow. It's interesting to see how 2 weeks ago it held this high from back here in March. Pretty tight range here. There are some big names reporting this week, like Microsoft in the Dow. So that's something to kind of bear in mind. Now the Russell, I think, is also interesting because we have some resistance here. Look at this zone back here. I'm highlighting, in early February that now we're kind of squeezing up against. And from my perspective here, this is the sort of environment where the Russell could really come back into play. And the reason why is we're going to get to the Treasury yields, but from my view here, we're in a spot where there is more of a sense of M&A, more of a sense of an equity market overall, more of a sense of the Fed cutting at some point, and as we move toward that sort of situation, that could be a favorable thing. But I just think right here we have to realize is that, I mean, it's not exactly, a bullish triangle, but if you do look at it, we do see essentially here that we have these higher lows, and a person could kind of view this as something of a kind of a, depending how exactly you want to look at it. It could be viewed as a triangle with some breakout potential here. So from my view, this is also something where as we kind of move through earnings, or I'm not we'll even going to necessarily know exactly what the overall catalyst would be, but the point is that this is something that has consistently higher lows, and it has interest rate sensitivity. So if we do see some more downside in interest rates, that's something that people might look for a breakout. And so from my view, the level on the RUT that matters is really between 22.78 and around 22.88 on the Russell itself. And I think if you look at basically the levels from the last week of January through basically the second week of February, you can see there's a 3-week range here where it was like the close, it was the high, and then the close before we started selling off. So this range back here, I would say on the weekly chart, late January, early February, is kind of the level that might be viewed as the important level, and a close above that might actually result in some more kind of interest. And the thing about the Russell is, it's still below its all-time high, and this could be something where if people decide that it's time to buy the Russell, it could get something of a stampede into it. So I'm looking to see if that might be something we can identify, or at least be kind of watching out for. But it does have this kind of potential to have a relatively fast catch-up trade. And that might be an opportunity that people might be wanting to look for. Now, the 10-year Treasury yield is increasingly interesting here because it does just kind of keep squeezing into this kind of range here. From my view, I think we want to see what happens. But my sense is that we're maybe, if anything, I mean, there is a potential, I think, for this to break lower. And this is the yield, which would be, positive for stocks overall. And, last week we had the strong Treasury auction, and I think it's interesting that Jerome Powell is being left in place. The Fed's credibility is not being compromised. It creates a situation here where people are going to say, you know what? Again, why am I not buying treasuries? Why am I owning all this gold? It does create the potential of a back to normal trade. And a back to normal trade, in air quotes, a back to normal trade would mean, owning more treasuries and owning less gold. And, there is this whole idea of de-dollarization and all that sort of stuff. But that story is, potentially has played itself out for now. So I think we want to kind of watch and see if we do get a rotation away from things like gold and back toward the dollar. And if you get a move back toward the dollar, you might get a move to the dollar assets of the 10-year Treasury yield. And I think that's just important to realize because, the Fed now there's, I think 75-80% chance of a cut in September, according to CME. So, that's something where if we have a sense that inflation is low enough and the Fed is going to start to cut, this could be something where we see downward movement. I still think we have to watch this as an important chart. To me, the even more important chart right now, though, is the dollar index. And we talked about the completion of this Elliott wave to the downside. Now, I don't normally use Elliott waves, but it is kind of a useful tool just to kind of see when things complete these kind of, three directional waves. Or, I'm not a big Elliott guy, but it did apply in this one. And I think the key thing here is that, this has priced in significant news that might not really be the case anymore. If we get this move down in yields and then we have an American economy that is not in recession and maybe inflation closer to 3 than to 2.5, and maybe we get one cut and that's about it. And, the argument for continued downside in the dollar may have kind of, passed for now. And, with currencies, if you're maybe if you're an emerging market or something, your currency might go in a straight line. But usually with something like the dollar, it tends to be more range bound. This is basically the dollar against the euro. So there might be some potential for some mean reversion, and that could last a quarter or two. We could see maybe through the end of September, maybe there's a rebound in the dollar, for Q3. And if that's the case, I mean that could be something that is not great for gold and global equity. So want to just kind of put that out there. That is the DXY. Now, remember, we were talking about this when this breakdown happened. We talked about it quite a lot as it was happening. So I do want to emphasize that. We've been making this observation about holding this level for a while. So for me, the move here to look at, the first one is a move up toward 99.5 on the dollar index DXY. Now, XLB materials. This might also be something where, maybe the way to think about something like this is, do you want to be owning materials right before Meta reports earnings? I mean, who cares about materials when you have, Microsoft, Meta, Apple, big names reporting earnings? The buzz we had on these materials and the steel and all that stuff, that might have played out. So for now, I think this is something that people might look for some potential consolidation and chopping. And the other thing is, a lot of the move last week, if you actually look last week at materials, it was because Newmont Mining, NEM, had a very strong earnings report. But again, that's like a one-off thing. It's a gold miner, though. So it's a one-off sort of random thing. And I think right now with materials, it is kind of, go back to the weekly, this environment may not really favor it. So my kind of overall, I like to sometimes kind of map out playbooks, look at the future and say right now when everyone's reporting earnings, and we're going to probably have a Fed that is non-committally hawkish, but leaving the door open to a move in September. In that environment, do materials make sense right before, Microsoft reports earnings? Or does it make sense to let the earnings pass and then when there's the assumption of a rate cut in September, do we see a run into the September meeting? Something more like that. So I just want to kind of map that out, that the opportunity in something like materials might be when we're more kind of, licking our chops for the rate cut. And that isn't where we are right now. Communications are very similar to the Qs here, but I do want to mention that, I'm just noticing this weakness in telecoms, and I think that communications have had a really good move. They're not massively cyclical though, and everything else, and so there's a lot of news priced into this, and this might be something where there's nothing bearish about this chart, but there might be some just continual consolidation in this area for some time, And when you look at some of the moves and things like Meta, the fact that Google did not break out, which I think is also interesting. Google just kind of sitting here. This might be something that needs some more time overall. So the XLC here, it's had its run, and it might be something here where it is more kind of has some time to pause. Now, energy has been very interesting because of this. Some of the Russian news today. There's been a little bit of tension actually in the Middle East. There was something with an American destroyer or something a week or two ago, and it was in Iranian or near Iranian waters, and there was a little kerfluffle about it. There's also a report that the Saudis want to raise the oil prices to Asia in September. Um, to me, overall, energy does remain in a spot where it has this potential for a break to the downside, but it's not super confirmed. Um, so I I'm just watching this to see, and I think we have 26 and kind of 89, and let's just kind of see what happens. At this point, maybe it does get a resolution and things break to the downside. But I think with this Russia thing now lingering out there, that Trump came out and said that he wants to basically be more aggressive with sanctions on Russia for people buying Russian oil and all of that. It kind of puts the geopolitical the geopolitical thing back in play. So, I think that there is still some geopolitical things out there that might pop up. And who knows? I mean, the Middle East, you never know when something else is going to jump up there. So this is something here that, from my view, doesn't really give any clear opportunities because taking a clear position and then suddenly being surprised by events that happen on the other side of the world can be a difficult sort of thing in terms of risk management. Now, XLF financials here, my view, this is kind of that we had identified this level and it worked. It went down, had a false breakdown, extended above that, and now maybe I think the support here just kind of moves up to around 52.54, which was the weekly close 2 weeks ago. That is XLF. XLI almost identical, and like we said, the support moves up to here. Weekly close from 2 weeks ago might be the kind of support that people are going to look for. And I think overall, like we said, XLI and XLF are now there's the potential of these guys basically becoming like Mag 7 and kind of pushing out, you know, consumer discretionary, or maybe even pushing out communications. Maybe communications not massively cyclical. It can maybe stall and then have some attention shift to things like industrials and financials. So from my view here, XLI, XLF have that kind of cyclical bent, and that's where people are focused for now. XLK with the earnings coming up, this can kind of chop around, but there is some support. We moved up to last week's low around kind of 257. You might also look for this kind of level up here, which was the close 2 weeks ago at kind of 261 area, but that's also close, very close as well. So with Microsoft earnings and some other stuff coming up, it's just going to be, from my perspective, more of going to be based on those events. It's very similar to the chart of the Qs. XLP here, from my view, people looking for some downside. This continues to kind of, I think, point in the direction of a test back down towards 76. Inability to break out, this kind of just limping at this $80 level. Consumer staples here remain in a kind of challenge place, safe haven in a risk on market. So this is something people might look for a move down towards 76 in the XLP. XLRE, real estate. We had talked about this kind of potential for it to break out to the upside, and I think right here, it probably just needs to kind of sit and hold. And we had said all along that this is something, when you really look at where XLRE, I'm sorry, is it basically it's long-term high up around 45.5 is not that far away from where it is right now around 42. People might really want to wait for a more really clear breakout above these old longer-term historical levels. Otherwise, you're just kind of down here in a kind of purgatory of range-bound uncertainty. So I'm watching XLRE for this, and I don't see much in it. Now, XLU, we had talked about the breakout, the weekly high. It had the extension, and from my view here, people could be looking to be buying this, between 83 and 84. But this has that confirmed breakout above 83. And like we also see, looking back at XLI, it was a classic one. This was the all-time, weekly high. This is an all-time high right there in the first week of June. What did it do? It pulled back for 2 weeks, held, and then launched. So XLU, here it is pulling back the second. It had continuation, then pulling back this first week, and then people might look for lows, back down, maybe even 82.5 on the XLU. Healthcare, XLV. there have been some more slightly positive things in it. From my perspective, this is something where it's range bound and probably, you look at this, it seems to have this kind of level around 137 on the XLV down to like 130, 129. This kind of range bound sideways potential here. So from my view, this is one here that also doesn't really offer much. Back at the top of the range, it might get swiped back down. There were some companies that had some interesting numbers. But the sector overall remains, kind of challenged, and it might need to really see these issues with the health insurers and everything else really go away. We might need to have a little bit more of a, clarity on, are we going to have tariffs on medicines and things like that. So I want to just mention it. We had talked about this long-term topping pattern in XLV, and it does remain kind of sickly. And then so basically 136 back down to 129 area might be, 129.5 might be more where people are looking at. Now XLY, this is the one that maybe gets more interesting here, in addition to the Dow. Now Tesla last week, the numbers were not that great, but now Tesla in some ways, I mean, if you look at how tight this thing is, Tesla is now in a spot where, I mean, I am not a big Tesla guy. Like some people just trade Tesla all the time. But what is interesting to me about this is that essentially you have a company now where there's huge bad news known and significant, news that might be good that is coming. So as they start expanding this robo-taxi service, in some ways it might be in a spot when it gets just pure benefit of the doubt. And I think that's important to realize here. Tesla, in many ways, drives the XLY. If you look at it directionally, look at this movie at back in XLY. Back at this point, this was all Tesla, right? Tesla drove this. See, this breakout in Tesla is what drove the XLY in late last year. So from my perspective here, I think this is a spot where there's a lot of bad news priced into this. And this might actually be in a spot when it can extend. We go into back to school and the end of your holiday shopping season, Amazon, Tesla, what we mentioned about the potential for something in home builders. So from my view here, this is potentially one that has the potential to extend back up toward its old highs, especially if we're in a market here that kind of is, low volatility stock picking like we often see. We've said that we're in a market now which is not correlated, it's more stock picking. In this environment, people are looking for opportunities. They're saying, what's a stock that could rally hard off the lows? I missed buying, AMD at like, $100. What's the next AMD? What's the next super micro? And then people might say, oh, wow, Tesla is still half of where it was, and there's robo taxis coming out. And so I think right here, that might be more of this sort of mindset, going into year end with a non-recession, consumer discretionaries that really have done nothing for a while, with arguably the bad news now having happened in Tesla may actually be a risk reward that people actually see as being favorable. So those are the main things we're going to talk about. By the way, we're not going to be doing any blog posts for the next week or two. We're updating the website. So we will be doing market trends on Thursday. But we will not be doing a blog post on it. So we'll just be doing market trends on Thursday. Hope to see everyone then. Have a great day, and I'll see you on Thursday. Don't forget, Wednesday morning, GDP, Wednesday afternoon, the Fed, and then more news on Wednesday afternoon with the earnings. Check out our article for more, and have a great day. I'll see you on Thursday.